Alright, so as of May 22nd, my total equity is 93,067, 68,543 in my TFSA, 30,665 in my RRSP, a negative 15,079 in my margin, and 89.37 in my RESP. So in this video, I'm going to explain why I definitely see myself as a chicken for missing out on 4 good trading opportunities, which I'm going to explain, and then I'll go through my trades of the day. So one trade I definitely missed out on was selling the straddle on Nvidia before earnings, June 19th expiration at the 360 strike. I would have collected $50. So basically I'm selling the call and selling the put at the current market price. I would have collected $50. So that's one contract. So multiply by 100, that's $5,000. So the way I would win on this trade is I would sell before earnings, collect $50, and then the next day when earnings is released and there's a volatility crush, I can buy back the trade for less. And in fact, that's what could have happened. This trade was worth $40 the next day when Nvidia released its earnings. So I would have made $10 per contract. So that's $1,000 profit if I had done this trade and it was just holding this trade overnight. And my break even basically on this trade is Nvidia has to stay between 310 and 410 by June 19. But my plan was never to hold it until June 19. But in theory, that's how this trade works. But this is an undefined risk trade. So I don't know what my max loss is. If Nvidia is trading at 420, for example, then this trade will be worth $60. If Nvidia is trading at 450, then this trade is worth $100. So I would lose $5,000. So that's the scary part with this trade, is that the risk is undefined. Although there is a small chance, of course, that it goes outside 410 and 310 by June 19, but it's still possible, and in theory, that's what scared me. So because it's undefined risk, I don't know what my max loss is. So yes, there is a small chance that that happens, but it's still a possibility, and that's what scared me, is not knowing what my max loss would be. But another possible trade I was going to make was the same thing, straddle, but with a May 22nd expiration. So this was going to expire the next day after earnings is released. So I was going to get the volatility crush, and the fact that the trade expires the same day, then the options are going to become worthless quicker. So this would be selling the call and selling the put at the 360 strike. I would collect $25 in this case. So that's $2,500. And my break even would be 335 and 385. So as long as Nvidia stays within 335 and 385 May 22nd, then I don't lose any money. If it goes outside, for every dollar it goes outside 385 or goes below 335, that's how much I'm going to lose times 100. So once again, it's undefined risk, but I mean, the range is pretty big. So it's still a 50-point wide range, so it makes it quite safe, but there's always that voice in the back of my head saying, what if it goes past 385? And I don't know by how much it can go past 385, or same thing below 335, although it's just one day, so it's really unlikely, but still possible. Anything is possible. And that trade ended up opening at around $6. So could have closed this trade for $6, collected $25, so I would have made $19 times 100. So that's $1,900 in an overnight trade. Now, the other trade that I chickened out on was the same straddle, May 22nd, but the next day. So not before earnings, but after earnings. So after earnings, when earnings was announced, this trade was trading for $6. So selling the call and selling the put at a 360 strike gives you $6. So times 100, that's $600. But this is after earnings, so it's already made its move. So the break even would be 360 plus 6, so 366 and 354 for the end of the day of May 22nd. So Friday at the end of the day, as long as it stays within that range, then this trade is profitable, doesn't make me lose money. Anything outside 366 and 354, for every dollar it's outside 366 or below 354, that's how much I'd be losing times 100. So this trade I could have done on the same day, Friday, May 22nd, and close it at the end of the day. And do you know where Nvidia closed the day at? It closed at 360. So this trade, if I had done it during the day on May 22nd on Nvidia, would have collected $600 and could have closed it at the end of the day for $1, made a $500 profit. But knowing myself, most likely I would have closed it at 50%. So it would have made an easy $300. So out of these 3 trades, I think this is the one that I should have done. This one was probably the safest out of all 3, because this was same day. So it's very rare that it's going to move that much within the same day. Overnight, yes, it could move a lot overnight, but after earnings was released, there was still $6 left in this trade, and it could have easily taken advantage of it, but I didn't. Now, the last trade that I definitely missed out on, this one I had talked about in one of my videos, is selling the naked call May 22nd expiration on Nvidia at a 450 strike. So when Nvidia was trading Thursday at 360, I had the chance of selling the naked call on Nvidia at a 450 strike, collecting 25 cents. I would have done 10 contracts though on this, so I would have collected $250. And then when earnings is announced the next day, as long as Nvidia stays below 450, which has a very good chance, of course, of staying below 450, it would have to move 90 points in one day. So as long as it stays 450, then I keep all the profit. And in fact, the next day, Nvidia was trading between 350 and 360, and the trade was worth 1 cent. So I could have closed it for a penny or just let it expire worthless, since expiration was same day. So this is definitely another missed opportunity, an easy $250. Now, the capital requirement for these trades, I forgot to mention. I think this one was about $10,000. It doesn't mean that you would lose $10,000, but the capital required to open the trade was $10,000. And I think this one too was $10,000. This one as well, I believe, was about $10,000. And this one was about $5,000 capital required to open the trade. So if we switch from missed opportunities to the trades that I actually made, the trade I actually made on Nvidia for earnings was a put spread, June 19. 310, 305 put spread. So the capital required for this is about $500. I collected about $103 for this trade, and the idea was to close it for less the next day. Now, for some reason, there wasn't that much volatility crush after earnings, so I wasn't able to close it for 50%. The best I could have closed it for was about $60, but after commissions, I felt it wasn't enough. So I'm still in the trade, and I'll try to close it next week. But I mean, my short strike is 310. I just need Nvidia to trade above 310 by June 19. Nvidia is trading at 360. So it's still very safe, but for some reason, I wasn't able to close the trade. There was not enough volatility crush. Now, Alibaba, on the other hand, dropped after earnings, so that didn't help me. It's still above my 190 strike, but it's getting close. I mean, it's trading at 199.7. So pretty close to my short strike of 190. So for sure, I wasn't able to close a trade for 50% profit, but I'm still holding on to the trade. And that's why I go for 30 days to give me time to for this trade to become a winner, and gives me time to manage this trade in case I have to. And the way I would manage it is by selling call spreads on the other side, but same expiration and same width of the strike. And I also sold a June 22nd 276 271 put spread on the SPY, which is part of my regular Monday, Wednesday, Friday put spreads I open on the SPY. Collected, I believe, $80 on this trade. Now I had to roll the Qs, of course, my covered call on the Qs, which was at a 212 strike. My purchase price is 221 and the current market price is 229. So by having a covered call at 212, that means that I would lose my shares at 212. Now I don't want to lose my shares at 212 because my purchase price is 221. So I have to keep rolling. And this time, to roll from 212 to 213, I'm not proud of myself, but I had no choice. I had to go from the May 22nd expiration, 212. I had to go to June 12 expiration just to get the 213 strike. So I went 1 point higher on the strike, and I collected $58 to do that. Usually I'm able to do it 1 week at a time and collect the credit, but this time I had to go further out because the Q, the market price of the Q was way too far, and that's the problem. I need the market to drop a little bit. But in good news, I have 34 shares that are not part of a covered call. So this one's showing a $289 profit. In my RSP, I had to roll my covered call on IWM. IWM closed at 134.89. So my strike was 134. If you look under executed, you can see that my May 22nd strike was 134. So I had to move it to 139 strike for May 29th expiration. So I went 5 points higher, so that's good. And I collected $40 to do that. So I'm able to do that because IWM isn't trading that far away from my current strike. But in the case of the Qs is just flying. So the idea with IWM is I keep collecting premiums every week, selling calls on my position until it comes back up above 150, which is my purchase price. That's the same idea with the Qs, but the stock went higher faster than I could sell covered calls on every week. So that's the problem. But all I could do right now is keep selling calls on it as much as I can until it decides to drop back a bit. I don't think it's going to fly forever. It has to come back down a little bit. So when that happens, that'll help me out. All right, so that was my recap for my trades on Friday. So if you have any questions, leave them in the comment section below. And like always, if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back, but depending on your deposit. The other one gives you $50 in free trades. Thanks for watching.